Hi everyone, thank you for visiting my channel. This is Ali Sheikh. Today I want to talk to you about this most recent sell-off in the stock market and how you can protect yourself from these sharp sell-offs and when should you consider to start buying. So this sharp sell-off I'm going to call this coronavirus sell-off. So let's get into it. So what I'll be covering in this presentation is what really happened, how can we identify sell signals, how do we identify buy signals, and what's next, and what have we learned so far. So what happened? So this is on your screen. You can see that this is a 25-year chart of S&P 500. In this presentation, I'm just going to focus on S&P 500, the broader market index, and this will serve as a guide as well. What you can do for your individual stocks. Most likely, if you were to plot your individual stocks against S&P 500, the chart that you see on the screen, more often than not, you'll find find a similar trend. I doubt that there were any stocks that were going higher during this dot-com bubble, which is from 2001 or 2000 and ended in 2003, or uh, during this financial crisis during 2008. Similarly, as we saw the sharp sell-off, there would be hardly any stocks that you might be able to find that were going higher during this time period. So this is that chart for 12 years now instead of 25, and focusing on the most recent bull market that we have been seeing. So now if I were to add a two, and just to point out, this is a weekly chart, and if I were to add a 200-week moving average to this chart, you can see that the market started bouncing back in 2009, came up in 2010, resisted at this 200-week moving average level, went back down, and then when it broke it kept going higher. But every time it pulls back, it pulls back to test this average. So just for people who don't know what moving averages are, moving average, I think you all might remember what an average is from your school days. An average is you take sum of a few observations and divide it over those number of observations, and you get an average. And when you keep moving it forward, let's say for the past 10 days or 20 days, what have you, it becomes a moving average. So this line is drawn by using the most recent 200-week closes to come up with this average. So as you can see that the prices are erratic, going up and down, but they're going in this upward channel, and a moving average sort of smoothens it out and shows you a trend that it's an upward trending market. So moving forward, now if we disregard the moving average, we can draw these trend lines. We take the lowest points in this slope to come up with this slope, and over here I took these 3 points and drew a trend line. Now, by no means, it's not gospel, right? So that the market's going to pull back and every single time right on the dot is going to bounce back up. It's just a line in the sand. We are anticipating that if the market bounced from this level and this level, most likely is going to bounce from this level. And that was the anticipation over here as well. Of course, there will be, you can't control market dynamics, but this is sort of like a line in the sand to assess how far low can I expect for the market to pull back before I feel that is it broken, or is it still the trend is still intact. So here we have the trend line and the moving average, and you can see how close this moving average is to this trend line, and every time the market pulled back, it bounced on or close to this line. So moving forward, I drew an upper trend line as well. The market was moving upwards in this channel, and then like late 2017, it broke the upper channel and wanted to go even higher. These things show that people are just being too optimistic or too overly confident of the market, and whenever these capitulations happen, market comes back to test these support levels. And in this case, it was positive, and then it bounced back up, and then it was forming a new upward channel. But then late in 2018, we saw that it failed the support. So then once it failed, tried it 2-3 times. We'll look at it a little bit later. Tried it a few times, then it dropped sharply. And this is what we'll be focusing on. The most recent, like 2 or 2.5 years, we'll look into it. So this is where we are, right? So this is the past 2.5 years. And this is that upper line that I was talking about. This is where the capitulation happened. And then the market had a sharp sell-off. And then it tried a few times to see, whether it's going to bounce off of this trend line. But this is where it found support. Now, this is a daily chart. So this is a 200-day moving average. And this is where it was finding support. You can see over here, here, and here that it found support, started bouncing back. Then again, this is where in late 2018, this is where it was struggling, and finally it gave up and had a sharp decline in 2018. And this is where that 12-year trend line comes into play. This is where it found support, and the trend remained intact, and the market bounced back, and we had some sort of a V-shaped recovery. And then again, this upward move where for 2-3 months it would just non-stop every single day. It kept going higher and higher, and I think Apple was one of the largest contributor of this. Apple, Microsoft were probably one of the largest contributor of this big move up. And then this brings us to the most recent sell-off. Now, this is again just drawing a few other trend lines. I just wanted to touch on volatility, that every single time you see these sharp sell-offs, the volatility spikes. What is volatility? Basically, it's a standard deviation when we deviate from the mean, which is an average. So let's say, we're talking about New York City weather, right? And someone says, the weather in January, the temperatures in January in New York are going to be roughly around like 25 degrees Fahrenheit. And if we get a 40-degree day, that might be an anomaly, right? We might not see many 40 degrees days or 60-degree days, right? Just like that, so that's standard deviation. So deviation from the mean or on an average. So that shows how volatile, if that continues for a longer period of time, that increases the volatility because the gap between an average and the observation is too large. And as you know, that in the past 2-3 weeks, we've seen that the market has moved 7 to 10% on a daily basis, when we generally see maybe 0.5% up or down in market movements. When you start seeing, instead of 0.5%, when you start seeing large movements, volatility, of course, is going to go higher. So now, how do we identify sell signals? Now, coming to the most recent time period, we can see over here that the market kept going higher from October through late February, right? And this is where it broke the upper trend line. It kept going higher, came back to test it, kept going higher. And now we're just going to see that, these are some of the indicators that we can utilize. On the top, we have RSI. On the bottom, we have MACD. which is moving average convergence and divergence. So what does RSI tell us? It is a relative strength indicator. So to determine how strong the market is or how weak it is, right? So during the times of strength, this indicator keeps on rising. During the times of weakness, this indicator keeps on dropping. There's a line, the dotted line on the top is the number is 70 and the bottom is 30. So whenever it crosses this dotted line upwards, it shows that it's overbought. And if it crosses the line lower, it shows that it's oversold. Generally, you get like, generally it indicates that it could be a good buying time when a stock comes out of its oversold area and RSI is rising, it shows time of strength. Now for MACD, it is when this black line crosses the red line downwards, it shows a sell signal. When it crosses it upwards, it shows a buy signal. And then the third indicator, which I personally really like, is this moving average, because it is just taking the most recent activity and it is closer to the price. And if the price is above that moving average, which means it's above average, we like things that are above average, and the stock generally continues going higher. If the moving average is upward sloping, it shows that it is trending up. If the moving average is downward sloping, it shows that it's trending lower. And we don't like below average things, right? We like above average things. So keep that in mind, that you want to generally stick with stocks that are above average, above their own averages, and they continue going higher. And whenever they come close to their average, and if they're bouncing back off of them, that shows that it's generally a good buy signal. So continuing with sell signals though. Now over here, this is focus on the top over here. I'm going to go week by week. We had these 3 weeks of 2 or 3 weeks of sell-off, right? So on week ending Friday, February 21st, you can see that on Friday there was a sharp decline in RSI, showing that the strength is weakening. We had very close, or maybe it crossed over on MACD. On the bottom over here, you can see it on the right hand side, that it's sort of a sell signal over here. But from a moving average perspective, the drop did not come close to the moving average. So if I were looking at it, I would have said, okay, fine, the market dropped today, but we've seen that, and these are healthy pullbacks for a longer bull market. But the following week was a different story altogether. So here we have the week ending Friday, February 28th, and this RSI kept going down, and it ended up into oversold area. And then also this sell signal on MACD was confirmed as well. The black line crossed the red line downwards, and now I have a 200-day moving average instead of that 50-day moving average. And this is where I had drawn this line that, okay, and if you remember from the previous chart right here, that this 50-day moving average was close to maybe 32.75. So on Monday, it crossed the moving average down, so it was below average. It became below average. However, this now becomes a support line, right? Because we had the markets moved sideways over here. It bounced a few times around here. It bounced over here. So it became a support line. However, on Tuesday, then we had a sharp sell-off again. So this day, to me, was a sell signal. Now, I'm going to talk about the things that I have, and I've talked to a few people what we have learned from this. We always have to use these as a learning opportunity, right? So I actually bought on this day, and then Thursday right here, and then Friday right here. And hindsight 2020, I should have not bought on Tuesday because the trend broke, and we had such a massive sell-off. And this was all due to coronavirus. And for days we had been seeing treasury yields going down. So what the bond market was saying that if the yield is going down, that means that the bond prices are going up, which means there's more interest in buying bonds, right? So that money flowing into bonds had to come out of somewhere, or people were maybe just parking their money, whichever was on the sidelines, into the bonds instead of the stock market. So we saw this massive sell-off, and it was just we were just all caught by surprise. And this is where focusing in, or having those levels and keeping an eye on a weekly basis, just reassessing your positions, and managing your positions is very important. So now moving on to the next week, we saw that this was Friday, this sharp bounce back, and this was an old trend line, which then became a support line. We saw this sharp bounce back, and I was anticipating around 2900 we should get this bounce, or that would be a support. So, but then you can see that it came up, and then for 4 days, 4 days, the market was on or around this that top line that became a resistance now, and also the moving average, that it started resisting at this point. And this might have been a good indicator that, okay, you know what, we had this sharp drop, then we had this sharp increase. However, the market is resisting to go higher, and maybe I should, if there are, even if I'm a long-term investor and I have taken some new positions, maybe I should hold off right now and maybe take small losses and get out. But I personally didn't do that, and I also have limitations from work that I can't just sell within 30 days, so I was stuck. So then we saw, and one other thing, I did not deploy all my capital. I slowly started buying, and even right now I'm only 27% invested, so which I might think about trimming if the trend does get negative. So then we saw this market dropped again. It sort of made like a double bottom, but we needed confirmation, which we couldn't get this week, and week ending Friday, March 6th. So we had to wait till Monday, right? Whether the market's going to bounce from this point, or is it going to continue lower. So then the following week, this is that double bottom right there. Then market dropped sharply. The following day it went up again, and you can see that around 2900, which I was thinking initially was a support line, now it's like a resistance, right? The market didn't go above it. And then the following day it went down again, and we just continued going down. So on Friday again, we saw this sharp increase because Trump came out and announced the deal and all the testing that we're going to do and all the hard work that the government and the CDC are doing. And but how interestingly that the market just stopped right there. So identifying sell signals, if you are a long-term investor and you're looking at a weekly chart on a long-term basis, you can see that the weekly chart just takes out all these small moves and just allows you to look at the big picture. This is where we are seeing these support lines, and then on RSI you can see, just play around with this, and you can see that this sell indicator on RSI twice, and then what happened after that. But if the trend is intact, and if you're a long-term investor, that might be different for you. If you're a trader or a swing trader, having these indicators, to me, the three of my favorite are RSI showing me the weakness, MACD showing me these crossovers, and maybe a moving average, which might be closer to the stock price if I'm a swing trader, or maybe a longer term moving average. But we can, I'll probably have a different video on how to select which ones are the right moving averages for you. Now, identifying buy signals. So now the market sold off. How do you identify that, okay, it's the time to buy now? So this is from late 2018 when we had this sharp sell-off. The market came down from close to 2,900 down to 2,400 or 2,300 and change. And this was like a month and a half sell-off. So how do you determine that it is time to buy, right? So market sold off over here. Again, that moving average, you can see that the price is telling you that now I'm below average, and I don't want. You should not want to own below average things. I'm just trying to repeat that so that it hammers into everyone's minds. We want to look at this increase in prices over here, right? During July and September, we want to own above average things. We don't want to own below average things. So as soon as something becomes below average, you want to be really cautious if you want to buy it. A lot of times, people say buy the dips. Buy the dips to me means this pullback, it's still above average, buy it. Buy the dips doesn't mean if something's below average and it keeps on going lower, then you just want to be cautious. If you are a long-term investor and 200-day moving average is your line, then whenever it approaches that 200-day moving average, yes, it becomes a buy signal for you. So just to go back over here and to show you, this is that 200-day moving average chart, and also the 12-year trend line. You can see that every time it comes close to this, it becomes a buy signal for a long-term investor. But that's not the case if you are a short-term investor or a swing trader. So for me, price, we talk about all the things, right? What's driving the market, right? And we say, well, Trump is driving the market, policies are, Fed is, US-China trade wars are, coronavirus is, all these things collectively are driving the market. Every person out there is using one of these bases to make their decisions. And collectively, all of that translates into one thing, which is price. And that one thing, going up makes you money, going down loses you money. So if you think that everything out there, whether you know it, whether you don't know it, whether it's insider information and people are acting upon it, whatever it is, it's all being translated into price. So now, if it is translated into price and the price is above average and it continues to go higher, then collectively people have done some sort of a research which is making them bullish and all the indicators are positive. When collectively, it's all demand and supply, right? So collectively, if there are more sellers, which is driving the price lower, it's generating the sell signal and the price is below average. So what's my identifier for a buy signal? You can see over here that RSI was close to oversold and we bounced back over here, which is very close to maybe this candle right here. So that's signal number one. Then after that, we saw this MACD crossover upwards. The black line crossed the red upwards, another indicator for a buy signal. And then over here, then we had that confirmation where the price actually went above average. And then we got this great move higher, which was more like a V-shaped recovery. Now, do you really care if you miss some of the top over here or miss some of the bottom? What if you bought right here or right here or right here? You would have felt miserable for a month and a half, like right now I am, for buying a little bit sooner and violating my own rules. And why not just wait for confirmation for the price to cross this moving average upwards, or some indicators showing that the market is turning. Moving on now, this is the same time period, December. I'm focusing on so that we can identify these buy signals, and you can see that this is where we had that crossover in RSI. We also had that MACD crossover over here. But one of the great things that you want to see that, when the prices are dropping, that when it rallies up and it comes back down, you want to start seeing higher lows. You don't want to see lower lows, right? So this is a low, this is a low, but then this is a lower low. Then every single week following that or day following that, we kept having lower lows. And then we went higher, we pulled back a bit, and we saw a higher low. Then the market continued going higher, then it moved sideways. So all these are higher lows that we want to see, which shows that the price has gone above average, which is a nice indicator for us to continue owning it. Again, volatility, that you can see that volatility was pretty high, and this is right here is 2019. So this is this line right here is 2018. So you can see that the volatility had started coming down a bit. However, the prices were still going lower. December 24th was somewhere around, or was where we had the lowest low, but the volatility, you want to see continued decline in volatility. I have a moving average on this volatility. Is showing that, okay, if you want low volatility, where generally the prices are going higher, so why not also put a moving average on the volatility? So when volatility is above average, you want to stay away. When it's below average, you want to start maybe buying cautiously, of course. So just wanted to show you volatility as well. And then we saw 2018. Now I just wanted to show you 2008 financial crisis. A lot of people might not have seen this or might not be invested in the market during this crisis. This is the Great Recession. You can see that, I drew this trend line that, the market came down. I have three moving averages over here, 50, 20, and 35 day moving average. The closest, of course, is the 20-day. A little further, the middle one, the green one, is 35, and then the black one is 50, because that's moving the slowest. So the market started pulling back. You can see that it kept on getting support around the 50-day moving average, but then when it dropped sharply, and then it around all these moving averages, it started resisting, and then it rolled over, and then it broke this support line, because we can look at this bottom right here, we can look at this bottom right here, but then it sharply dropped, and it broke the support line, and then it dropped even further. Then this is the confirmation that, things are going to get bad, or things are bad, right? Who knows how bad things are going to get, but this is an indication that things are bad. So it went up, it's kept moving sideways, right? Kept range bound, stayed range bound over here, but then again over here it found resistance at the 50-day moving average. So if you're looking at these things, this is the time, or this is, you might not be able to time it perfectly, who cares, right? But this is where you might want to be mindful that, okay, prices are below average, and I don't like owning things that are below average. So now it's going to continue, and you saw that it continued rolling down, and then same thing over and over again. It broke the support, went up, faced resistance, rolled over. So rolled over up here, bounced back, faced resistance, rolled over. Bounced back, faced resistance, rolled over. And then we had these sharp sell-offs, but even with the sharp sell-off, these bounced back, faced resistance, and then eventually rolled over and continued going down. But you can see that all this time, starting from June of 2008 to March of 2009, market remained below 20-day moving average. And all this time, starting from probably around 1350 or so, all the way to 850 or so, you could have been out of the market. And or if you like shorting or buying puts or whatever you want to do, if you just like going long, you could have been out of the market, sitting on cash, salivating and waiting for that great opportunity to get back in. So this is like a buy signal right here. Moving on. So we're talking about buy signals, right? So moving on. Now, I just wanted to again show you the chart of this 2008 stock market decline using this 50-day moving average, and also with the volatility, how volatility kept on going higher when the stock market kept on declining. But as you can see over here, from this point onwards, market was declining in price, and the volatility was also coming down. So all these things, you could use many indicators out there. You could use RSI, MACD, volatility, listen to people. However, there's only one thing that's going to make you or lose you money, which is the change in price. So you have to remember that if the price is below average, it's not good. When it crosses above average, that's when you want to own it, and you want to own during the moving average being an upward sloping average. So what's next? This is where we are right now. This is what we saw in the market. This is around the 24th or 24th right there, 24th of February, and this is where we are. We ended on March 13th. Now, I'm just going to take you forward from this point onwards and draw some lines over here just to show you the point. Now, this is where we had that downward sloping RSI. We had a sell signal on MACD. We can draw this line that it dropped and broke its support line. Then what happened? Then it kept on going down. It bounced back from a certain level. I drew this line after the fact, right? I didn't know it's gonna from another support line. I knew that it would probably somewhere find support around 2900, but then it bounced back, found resistance at this 10-day moving average. As you can see over here, it's a 10-day moving average, and it dropped again. It didn't even try this upper resistance level. It dropped from the 10-day moving average, and then it came over here. So if this could have been the double bottom, and it could have gone higher from this point, but the market wasn't convinced enough, and it wanted to go even lower. There's just so many factors out there, right? How is the government, U.S. government, dealing with all of this? How is what is the impact going to be on coronavirus? There is oil price war going on now between Russia and Saudi Arabia. So there are just so many factors out there, and it could be shift from equities to the bond market. Who knows? But one thing that we do know, the price went down even further. Then we got a bounce back, and then this support became a resistance. And then the price even fell further, and I was anticipating that somewhere around 2600 initially, but then somewhere around 2500 the market should, that is where we have that 12-year support line. So if we break the support line, then I don't know where, we're breaking a 12-year trend. So then on Friday, March 13th, we bounced back over here after that Trump's news conference, and last 35 to 40 minutes of trading, the market had a remarkable recovery, and we were close to 10% higher. So where are we going next from here? So I just wanted to draw these lines over here that if I were to just continue this 10-day moving average downwards, because that's the slope, it might just continue downwards over here. Now we've seen once and twice that the market when it bounced back higher, it then finds the previous support as resistance. Now over here, these three candles right there. Now first of all, we need to go higher than this. Then the next resistance could be this 10-day moving average, because obviously all these things are going to evolve in the upcoming days. What I would like to see, I would like to see the price break this moving average higher for it to continue higher. It and what I would not like to see is it just dropping down from this resistance line on Monday, or going higher on Monday and then on Tuesday or some other time, it touches this 10-day moving average and rolls over again. That those won't be good signs. So, that's what I wanted to share. You guys should look at your positions, and hopefully we continue going higher. But even if we go higher and then drop, you want to start seeing higher lows. It needs to go up in this fashion. You need to see higher lows, so that there is a confirmation that, okay, we're going to start seeing an upward trend over here. Um, RSI up here did cross above the oversold area. It did over here too. It did over here too. So it doesn't really matter. It's just an indicator that it's oversold and it's due for a rally, right? But we still haven't seen a crossover on MACD where this blue line would cross over this red to show a buy signal. We are seeing that, okay, we get periods of weaknesses and periods of strengths. However, price isn't breaking its trend higher. Price is still below average, and we haven't seen a buy signal on MACD. So this is 2008 again. I just wanted to touch it up again. Just look at these. These are typical bear market rallies. You get this rally, stocks or index or the market finds resistance at the moving average. Again over here at previous supports. It bounces back, resists at those previous supports, and rolls over. These are classic bear market rallies. So we broke the correction. We are in bear market, and let's see if the market wants to go higher or not. So this is where we are again. This I just wanted to show in conjunction with volatility, how volatility spiked and how the price is going down. However, the only thing again that's going to make you money is the change in price. Finally, what have we learned over here? First two are from myself. Note to self: only change in price results in gains or losses. If you see these pullbacks, like on when the first week when I started buying, I had no idea what could happen in the future, and the trend was still intact. Maybe I should have limited my buying, but I violated my first rule, and then I went into irrational exuberance, where I said, you know what, the market, thinking that the market could never turn the other way, and that's what just that irrational exuberance pushed me towards buying, and I'm glad I was still disciplined enough not to put all my eggs in the same basket at the same time. I slowly started building a position, and majority of probably like 20% out of the 27% invested is all in S&P 500 and other mutual funds. So I'm diversified there. Then I spoke to a few other people, and these were some of the points that people learned out of this sharp pullback. You should be diversifying outside of the stock market. You should always have an emergency fund in case you need cash, right? Or in order to survive for a few months or weeks or whatever. And then don't let others influence your decisions. You should be able to make your decisions, and just live with them. And then you should always have some dry powder on the side. You should have cash to buy more positions or during these sell-offs. Again, never buy all at once. Don't be scared to take a position. Look, when we're investing, we have to be courageous but not stupid, right? So the only way you're going to make money is by investing, by deploying the capital. If it sits on the sidelines, that cash is not going anywhere. So don't be scared to take those positions. However, have a plan. You should have your targets before you even take a position. If you put in stop losses, don't just keep changing them. If if the prices are going higher, maybe put in a trailing stop loss so that it trails the price higher. But stick to your plan. So these were some of the things that I wanted to share, that what I've learned and what others have learned, that whom I've spoken to. And then that concludes my presentation. I hope you got something out of it. If you liked it, kindly hit the like button. I do want to stay connected with all of you. So if you would like to leave some feedback for me, I'd really appreciate it. I'll try to respond to as many questions as I can. And I want to start maybe posting these videos on a weekly basis. So your feedback will give me ideas of what I can touch on for the betterment of the community. And also, don't forget to click on that bell icon so you know when I've posted my next video. Thank you and all the best, and be careful out there. Thanks. Bye.